Welcome back, everyone. To recap from our last lesson, there are four main types of risk: market, leverage, liquidity, and counterparty risk. In this video, we are going to take things further, look at risk a bit more from an individual trader's perspective, and then at some simple techniques using orders to help manage market risk, the most tangible risk we face as traders. Before we get started with orders, I want to touch on the most obvious and the best long-term risk management tool.
What's that then?
Well, it's you. Now, I don't want to deliver a self-empowerment sales pitch here, but I do want to get the point across that in trading, this is down to you, the trader, to take responsibility to understand and manage your own risk.
That's a bit of an obvious statement.
You would be surprised at the excuses I've heard for losing trades. It's the market's fault. It's the broker's fault. It's the Fed chairman's fault. No, trading is down to you and you alone. Good traders understand this. They don't rely on others.
So do you have any practical suggestions for traders at our stage of development?
Yes, make sure you educate yourself properly. I'd like that to be with us, but if it's not, make sure you keep on learning in some capacity. The fact that you are starting to become aware of the four main risks, along with the rest of the topics covered in this introductory course, already sets you apart from other traders that are just starting out.
Well, that's good to know. It gives me confidence knowing we're well placed.
You are, but you have some way to go. I'm mystified when new traders start out without any education and expect positive results immediately. You don't expect to drive without first taking lessons, nor win a race without training hard. Trading is no different.
It's a good point. Perhaps it's naivety or the assumption it's easy?
Perhaps. That leads me on to my next point. You need to accept the risks are significant. Next, make sure you genuinely understand there is a good reason why FCA-regulated brokers are made to display the phrase "losses can exceed deposits" when marketing margin trading services. It's so that traders appreciate the risks involved and understand they may lose more than the amount they deposit.
Okay, that's noted. How do we protect ourselves against this happening?
Start out slowly. Use a practice account until you are ready to trade. When you do trade, trade with a plan. All good traders make sure that they don't place a trade until they are happy that it meets their trading plan. Your plan needs to fit with your strategy, your style, and it needs to protect you against your weaknesses. We've jumped forward a little bit here into one of our more advanced courses. We will look at the trading plans, strategies, and personal profiling in more detail there. Now, we are going to look at the most popular risk management tool, orders.
Okay, sounds good.